Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month copper. In January, I compiled and published my annual video commentary on LME 3-month copper. Please look at the YouTube index to find it. In this, I looked back and found a very relevant technical pattern for the action seen since mid-December last year. Now, that key piece of evidence recreated here on this daily chart is the bright red 2009 to 2016 bullish shift pitchfork, and the specific key piece is the bright red upper tine, currently 13388, that sits just above the top of the market and has capped, despite being significantly pierced on one occasion, that's capped a number of significant thrusts higher, seen in January and February, and even very early March. Indeed, this is the key piece of overhead resistance and only piece of overhead resistance seen here since the break up and out of the recent showdown of this market in mid-December last year, July 2022 to January 23 shallowy bullish shift pitchfork. So this leaves us with the question, what now? Well, there are two possibilities, with one of them having a subplot, and none of them are really satisfactory. The first possibility was to look at the whole 2026 action so far as a possible complex top. And the best we can have as a proxy for a neckline is the 50% Fibonacci line, November 25 to January 26 move at 12,571. The subplot to this is that we also now had what looks like a multi-bottom diamond pattern formed between late December 25 to date. It's not an easy diamond pattern, and with really increased chances of false breaks such as we might have seen over last week, I'm not willing just yet to call it a diamond top pattern. However, I had hoped we would know more by the end of February, but sadly this has not been the case, and I'm now watching to see if the market will test down to that 50% Fibonacci line below. The second possibility is to look at the whole 2026 action as a possible bullish halfway hesitation, running from as far back as mid-November 2025 action. To be honest, this is even more unlikely, but it would be churlish of me not mentioning it as a possibility. This then leads us to what I said 3 weeks ago when I said, and for now I will stick with this as an idea, and I quote, "Until things start to get clearer, I'll stick to the idea we have a trading range between the 50% Fibonacci line at 12,571 below and the bright red upper tine above." End of quote. This seems to have worked now for these past weeks, so until it changes, this is it. LME 3-month aluminium. The market's break higher in early January started a move higher that continues sort of till now. It has helped identify another larger pattern that has also been happening at the same time. This is not a very defined pattern, has been once more breached on the upside over the past 2 weeks. Plus, I don't think it has the required number of touches per side as yet, but we seem to have an April 25 to date very large rising expanding wedge pattern, outlined in bright green on my daily chart, currently 29.69 to 34.35. We just about remain within this pattern despite a spike higher 7 weeks ago and the previously mentioned action over the past 2 weeks. The repair on this is still very fresh and I'm cautious about it, but it is the one to watch. Interestingly, the action from December last year to date has also lent itself to be seen as a possible diamond pattern, but not, repeat, not to the same degree, same level as the one seen in LME 3-month copper. Here it looks less integrated and we've had a contrary move higher. These two moves allowed me 2 weeks ago to draw a new mid-December 25, start of February 26 dark blue bullish shift pitchfork. We are today after a breach higher last week, in between the dark blue upper tie and above, currently at 34.91, and a dark blue middle tie and below, currently at 32.98. More on this pattern as it develops. Another feature to watch for, and one that became evident to me on my longer term chart when compiling my annual video commentary, which you can find this on the ADM ISI YouTube channel, is a very large November 2015 to April 2020 bullish Andrews pitchfork, bullish shift pitchfork, which I transposed, which is a bullish Andrews pitchfork, which I've transposed onto this daily chart and highlighted in purple. The nearest part is the purple middle tie and above, currently at 34.21, which had helped in the past, despite being breached, had previously helped the bright green upper trend line along with that, to cap the market. This one is still being put under pressure. It's not unusual to see market tackle two coincident resistances such as these at the same time, so that the effort is maximized in trying to break higher. Now, 3 weeks ago I said, and I quote, "I'm considering running an optimized uptrend, possibly from late January or even as far back as November last year, just below the green short medium moving average." It's currently at 31.78. However, on reflection, why bother, as the green short medium moving average is doing a good job as a proxy for such an uptrend. End of quote. I have no qualms with keeping to that idea, for now at least, keeping the green short medium moving average as a proxy for an uptrend for now a 5th week. LME 3-month lead. The market tested and failed at the 50% Fibonacci line of the May 24 to April 25 move at 20.98 in mid-January. Indeed, I think this 50% Fibonacci line also caused the high seen back in November last year, as well as earlier in January this year. Since then, we've pulled lower, down through the close-knit moving averages. In the process, the market created a small January base head and shoulders top, breaking below the dark blue neckline, currently at 19.94, late 7 weeks ago. The primary target was reached 6 weeks ago, but it was only last week, in that spiking move lower, that prices reached the secondary, harder to reach target X1, below that important 38.2% Fibonacci line at 1939, down at 1921, and even dipped lower, down to a mid-April 25 low at 1888 before pulling back up this week. We can now see most of the moving averages starting to head lower and separating out, a significant feature. To look at this, well, I said 2 weeks ago, and I quote, "The whole action from mid-January today as a possible bearish cat's ears pattern. This is akin to a double top forming after a steep fall, such as the one seen from mid-January." End of quote. I further added at the time, and I quote, "As you can see, there is a lot riding on that 38.2% Fibonacci line, which has been breached, but under which the market has not yet stabilized. So please, because of this, please be aware of possible false breaks lower." End of quote. Excuse me. In truth, though I expected a move lower, I did not expect it to be achieved all in 2 days, as we saw over last Friday and this past Monday. But that is what we saw. A target for the bearish cat's ears pattern would be down in the 1880 zone, 80 zone. Now, with a low on Monday at 1883, I reckon that counts as a market that reached the 1880 zone. This brings me to my final point, the point I've been making here since the start of 2025 and will continue to do so going forward. It has been and still is to me the most important point of all. So at the end of December 2024, we saw that 2024 itself had created a very large and rare annual key reversal down in LME 3-month lead. We haven't done that much since until very recently, and indeed prices are only about $20 odd or so, $20 odd or so lower today than they were at the end of 2024. Now, this is not an endorsement of the annual key reversal down, but neither is it a strong countermeasure or repudiation of it. Hence, I still say, even now with prices where they are, one should still look at all things going forward in this coming year and beyond, in this metal, in the shadow of this longer term bearish pattern.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.